In this week's video, we'll review the latest charts and data to help us ask and answer 10 questions for investors. Are we still clearly in a bull market? Based on the facts that we have in hand, the answer is a definitive yes. What is the most common human error in a bull market? I think you can make a rational argument that it's overtrading. Key findings from studies: most active traders underperform less active investors and the market. Highest turnover group of traders earn the lowest returns. Investors lag markets largely due to poor timing and excessive trading. Attempts to trade in and out reduce returns and raise risk. These findings are consistent across decades, market cycles, and bull and bear environments. Notice, we said overtrading. When the odds are in our favor and the weight of the evidence allows, we want to act as close to buy and hold investors as prudently possible. Because all things being equal, activity tends to reduce performance when the odds are in our favor. There's a reason why we use the term overtrading. Because when the weight of the evidence begins to shift and eventually it hits a point where the odds are clearly not in our favor, we are happy to make incremental adjustments via trades to reduce our exposure to risk. Are there observable signs of broadening participation in the bull market? Yes, this is a monthly chart of emerging markets EEM relative to SPY. And as you can see, walking forward from this low here in Q4 of 2024, EEM has outperformed SPY. The same can be said for ACWX. From this low here in Q4 of 2024 to this point here in 2026, this A to B move here represents outperformance. And it's a little bit more advanced and pronounced in FNDF relative to SPY. On the monthly chart, the ratio is above the 50-month moving average. It looks different relative to most of this in the rearview mirror here dating back to 2018. And you can see it looks like the 50-month moving average in blue is trying to turn up. Similar situation with metals and mining XME relative to SPY. Notice when we're consolidating over here in 2015 into 2018 and 2019, this sideways movement in the ratio of XME relative to SPY occurs for the most part below a downward sloping 50-month moving average in blue. Starts to look a little bit different here in calendar year 2022 and looks significantly different on the right side of your screen with the ratio above a now upward sloping 50-month moving average, telling us to keep an open mind about this long-term breakout from this long-term period of consolidation holding in a bullish manner. This looks significantly different relative to anything that we've seen in this window here. Based on the observable evidence, should we be making aggressive allocation shifts or some incremental moves? While this chart that we just covered unquestionably shows improvement, XME relative to SPY, if we look at the same ratio, metals and mining relative to the S&P 500, and use an AWAP chart, anchored weighted average price, so we're anchoring here to this peak in 2008, and we're anchoring to this peak here in 2011. The reason why we anchored to this point, and these points up here, these are turning points. This is a peak, this is a low, this is a peak. This is an important period of indecisiveness here where you come up, come back and tag these two lines that are intersecting, and then eventually you fail, making this point in here relevant as well. And even if we didn't have these colored lines on the screen, you can see there was a period of indecisiveness here in calendar year 2013 and into 2014. What once acted as support temporarily in here may now act as resistance. So we own some XME, but this look here would tell us that it's probably not prudent at this time to make aggressive allocation shifts. Hence, why we're making small incremental moves. Why a small incremental move? Because we can unquestionably see observable improvement here. We can see this, measure it, put it in a model. But there's also evidence that's telling us we should move at a prudent and measured pace. We own some XME, so if it continues to move, the ratio continues to move in this direction, and we get out to this white space out here, we can continually, incrementally add to the position. And if XME is going to outperform SPY for almost 20 years, because it just underperformed for roughly 17 years if we go all the way back to this peak here in 2008, if we're going to see 17 years, hypothetically, of outperformance, there will be plenty of time to incrementally add to this position and to participate in the new uptrend. Similar situation here. We've shown numerous charts in recent months that say some good things have happened with gold relative to the S&P 500. Dating back to 2013 here on the monthly chart, every single time we came to the purple line, it acted as resistance, except recently. So this is incremental improvement here. Having said all of that, this is an area here where you can see market participants were confused. Resistance, resistance, support. Back here, 2006, resistance, support. And we're heading into the white space between the two horizontal dotted blue lines here, tied to these points here and these points here, which represents an area of potential resistance, as do these downward sloping anchored weighted average price lines. This is potential resistance, possible resistance. So the look here aligns with an incremental approach. Once again, gold has clearly been underperforming for well over a decade. If it's going to outperform for well over a decade, there will be plenty of time to incrementally add to our position and participate in that decade-long trend, hypothetically, if we continue to see incremental improvement on this chart, which may or may not happen. You may have heard the expression from Wall Street, bulls make money, bears make money, but pigs get slaughtered. We don't want to be greedy here. Gold has outperformed significantly. Silver has gone on an amazing run. But if silver can go straight up, it also tells us it can go straight down. This is intraday during Friday's session. At one point, it was down almost 32% in a single session. And while we have seen some outperformance in foreign stocks and some observable improvement, this looks different relative to most everything that we have in the rearview mirror here. The ratio of FNDF divided by SPY, so this is international large cap stocks relative to the S&P 500. It's a weekly chart dating back to 2014. While we can see significant outperformance in here, we really haven't made an important higher high above this level here from 2023 that acted as resistance. We're not above this level here from 2021 that acted as resistance. You can see price stalled here momentarily in 2020. Thus, this chart says something has changed incrementally in favor of foreign stocks, which is one of the reasons why we've taken a position. But this chart clearly shows that foreign stocks, even one of the best foreign stock ETFs, still has work to do, calling for avoiding aggressive allocation shifts and instead making prudent, incremental, and relatively small moves. Once again, On a chart dating back to 2015, foreign stocks have been underperforming for the entire window, roughly a decade. If this trend is about to flip the other way and FNDF or foreign stocks are going to outperform for a decade, we'll have plenty of time to make additional incremental adds to our portfolio so we can participate in the new long-term uptrend. There's no reason to get greedy or to overreact in the short run. We want to make prudent, calm, and measured decisions. We don't want to be making decisions based on FOMO or the fear of missing out. Are tech stocks, large cap growth stocks, and the S&P 500, are they all on the ropes? The answer is no. This is a relatively short-term chart of SPY, the S&P 500 ETF. These are anchored volume weighted average price lines. This is June of 2025 here. Support here, support here, support here, support here. And during Friday's session, on January 30th, around lunchtime, we're well above those anchored volume weighted average price lines. So even if we breach these lines, 2022 low wouldn't be in doubt. Right now, the trend from June of last year here isn't even in doubt. And that aligns with the weight of the evidence and the model scores that we covered earlier in the video. This chart goes all the way back to the February 2025 high. Still relatively short term when we consider that the trend in XLK started in late 2022, early 2023. So if this trend or this low here, when the tariff news became less bad in April of last year, if this trend were in jeopardy, we really would need to breach the anchor volume weighted average price line, the red line tied to this high, and the blue line, the dark blue line, tied to this low, right here and right here. And you can see during Friday's session, we're well above both of those lines, telling us that for the moment, we're not predicting anything. We're trading the chart in front of us. The rally off of the April 2025 low is still intact. You'll see a pattern here. Major high in 2022. Major low here. Eventually, the market holds near the intersection of these two lines. We got a high, we have a low. Eventually, the market holds near those two lines. If something similar were to happen in the present day, it means the current trend off of the tariff low in April of 2025 can come all the way back to the green and the purple line. And we know markets like to overshoot, so we could come back even into this area here. What once acted as resistance may now act as support. So even if SPYG came all the way back into this region here, we would still have a reason to try to remain patient relative to the rally that started in April of 2025. Moral of the story, this trend in isolation is not on the ropes at the moment, allowing us to remain patient and avoid overtrading. Similar situation if we look at XLK relative to SPY. A lot of volatility between this point A and this point B. But the trend has been from the lower left to the upper right. And we don't have anything relative to these AWAPs that tell us the current relative trend is on the ropes. Our interpretation of this chart would change if we moved into this area, and more so if the ratio moved into this area here. And that may happen very, very soon. It just hasn't happened yet. Same situation with large cap growth stocks, VUG relative to SPY. Anchoring at the start of a big move tends to make sense. You can see it acted as support eventually in this region here, and we cross below this line, the losses accelerated. So during the bear market in 2022, we tend to stay below the AWAP lines. And during the bull market, we tend to stay above the AWAP lines. So for this trend that started in late 2022, early 2023, the relative outperformance of large cap growth stocks relative to the S&P 500. If that trend were in jeopardy, we would once again expect the ratio to move below the colored AWOP lines. Support, 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 possible support in this area here, telling us that underperformance could still continue and really wouldn't have done a lot of damage to the trend off of this low back here. We're not making any assumptions about what happens next. The commentary about this chart and the commentary about all the charts and data in this week's video is based on the chart and data sets in front of us. In this type of environment, we're reviewing literally thousands of charts every week to try to stay on top of things. So what are we seeing over and over again in terms of leadership and emerging leadership potentially? First of all, one of the strongest areas are semiconductors. That does not look like a market that's concerned about an imminent recession. And as we've noted many times, it's difficult to get too concerned about large cap tech and large cap growth stocks when the chart of semis in isolation and the relative chart of semis looks so strong. That too is subject to change, but it hasn't changed in a material manner yet. We're also seeing strength in gold mining stocks like XME, more diversified in terms of their metals, physical gold, physical silver, foreign stocks, defense stocks, and still large cap growth stocks. Now we have stakes in every single one of these areas. And if the market tells us, based on the data walking forward, that we should increase our exposure here, here, or here, and reduce our exposure here, here, or here, we're ready, willing, and able to do so. One of the ways that we can address this issue is to think about our time horizon. These are long-term investments for us. We shouldn't be overly concerned about leadership in the next month, 3 months, or really even the next year. In the context of a secular bull market, we should be concerned about leadership over the next 3 years, 6 years, 10 years. And one of the ways that we can reduce overtrading is to look at trends that match our time frame. These are long-term investments. This is a trend here, an uptrend that began in 2011 or even before that, but you can see on the chart, it's in force between 2011 and 2026. This is a cloud chart. It's batting 5 for 5. Is blue above red? Yes. Is price above red? Yes. Is the green span above price? It is. Is price above the cloud? It is. Is the cloud green? It is. And we can even add, is the cloud rising? It is. What is this trend? This is the S&P 500 relative to foreign stocks. It's a quarterly chart. And relative to our time frame, a quarterly chart is not inappropriate. The secular volatility model uses a lot of quarterly charts. It can help reduce the human tendency, based on FOMO, to overtrade in bull markets. Also noteworthy, if we were to graph on a weekly chart with the 200-week moving average, foreign stocks, ACWX, relative to SPY, there have been numerous periods between 2009 and the present day of outperformance. Why don't we own foreign stocks? Shouldn't we have more exposure to foreign stocks? Why don't we own foreign stocks? Shouldn't you own more? In each one of these cases, eventually that outperformance, 100% of it was given back. This is a counter-trend move within the context of an existing downtrend, and trading into foreign stocks was a head fake. It was a head fake. It was a head fake. It was a head fake. Could this time be different? Absolutely, positively, yes. In fact, you can see something on this chart that looks different. Unlike this entire window back here, the ratio is now on that 200-week moving average. And that is one of the reasons why We have a small stake in foreign stocks. We're not ignoring this. How about this trend? If you're familiar with clouds, the cloud can act as resistance. And the greater the mass or the thicker the cloud, the higher the potential for the resistance. This could be strong resistance in this region here. You can see the resistance band is starting to narrow a little bit, but it's still quite wide, right around the region where the ratio is now. So the move from here to here was relatively easy. The move from here to here, at least theoretically, should be harder. And if we were to draw a horizontal line across here, it goes right into that area of potential resistance. So while there is observable improvement here, we are checking some bullish boxes. There's still work to do, and we're still checking a lot of bearish boxes. Is blue above red? Not really. It's close. Is price above the cloud? It is not. Is the cloud green? It is not. In fact, it is massively red. What is this chart? This is physical gold, GLD, relative to the S&P 500. It's a quarterly chart. And it too tells us that having a stake in gold, which we do, is prudent. Making aggressive allocation shifts after such a big move, a vertical type move, when we're reaching an area of potential resistance, probably prudent to do incremental shifts rather than aggressive reworks to our portfolio. And of course, one of the reasons why gold and silver are not performing particularly well was President Trump made his selection for the Fed chair, his nomination. It's good to keep in mind, a lot of this Fed independence rhetoric in the media is quite overblown. The Treasury Secretary, which works for the president, has been meeting with the Fed chairman regularly for decades. And members of Congress have been criticizing the Fed for political gain or for political reasons in front of microphones for over 100 years, both parties. Thus, trying to influence the Fed is nothing new. And even trying to influence the Fed in front of a microphone or in a public forum is nothing new. And think of all the pressure that President Trump put on Chairman Powell. He didn't flinch. He didn't change the decisions that he made. The Fed remained 100% independent. And if you're the next Fed chair, the pressure that you would have on you for lowering rates in an irresponsible manner and letting inflation get out of control and sending the economy into the trash can, the pressure that you would have from the American public and people all around the globe would be incredibly immense, much, much greater than the pressure from a few posts from the president on social media. Common sense tells us most likely the next Fed chair will also remain independent and be subject to political pressure, just as every Fed chair has been for decades. Is it a relevant topic? It is a relevant topic. Is it most likely overblown? Yes, it's most likely overblown. Now let's talk a little bit about relative charts. If we look at this chart in isolation, it almost looks like a blow-off top. Looks like an extremely strong trend that started to ramp up in 2017 and has just been killing it trend-wise since 2023. Looking at a trend in isolation doesn't necessarily mean that we should own it or own a lot of it. This is the same position, BIL, relative to SPY over the same time frame. This is why we spend a lot of time on relative charts. If something is going to outperform long term, then eventually the ratio chart has to flip. Let me repeat that. If something is going to outperform for a decade, eventually the long-term trends can't look like this. And they won't look like this, allowing us to prudently remain patient and incrementally adjust if things continue to improve. So SPY, XLK Tech, and SPYG and other major large cap growth ETFs still look good on a relative basis, and they still look good in isolation. And the charts and data sets that we have in front of us still say bull market. Thus, the hurdles to make changes are quite high. We do not want to overtrade. And we also have to consider tax implications. Tech, thankfully for us, has done quite well. Large cap growth stocks have done quite well. SPY, VOO, and similar ETFs have done quite well. In a taxable account, if we reallocate, that requires, since we're fully invested, creating a taxable event. And in that case, interrupting the compounding process. So let's close with these questions. Are we going to sit tight, make no changes? What's our next move, if any? What's going to happen next? We'll continue to take it day by day with an open mind about a wide range of outcomes, from wildly bullish to wildly bearish, and that includes market leadership. And we all know the only way that we can use all of this effectively and answer the questions on your screen effectively is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.